Welcome to Between Two Chairs, Demystifying Commercial Real Estate, the podcast that brings you the latest insights and trends on the South Florida commercial real estate market, with your hosts, Fernando Arencibia Jr. and Jennifer Woolman. In each episode, we dive into the world of commercial real estate and break down complex concepts to make them accessible for everyone. Whether you're a real estate professional, a curious investor, or just interested in the South Florida market in general, Between Two Chairs is the podcast for you. So pull up a chair and join us.
Welcome, everybody, to another episode of Between Two Chairs. My name is Fernando Arencibia Jr., and with me, as always, is the angelic Jennifer Woolman. Jennifer, say hi.
Hi, everybody. It's because the light's reflecting, and I made the comment that I'm wearing a halo. And now that song, Halo, Halo, is stuck in my head, but that's all I know.
I love it. I love it. Jennifer, this is always our favorites is when we get to interview an amazing professional in our industry. Would you kindly introduce our very special guest?
Yes, I'm super excited about this episode because if you're interested in investing in self-storage, either as an independent owner, a GP, or an LP, this episode is for you. I'm a wannabe investor, and this is the person I would love to invest with. We are interviewing Lauren Rothlisberger. She is the managing partner at Everett and Harvey, and I had the pleasure of meeting Lauren a couple of years ago at the Women's Investment Summit. And she's just one of those people that is amazing at sharing not only her journey and how she got there, but any information she has to help you as an investor or an LP or a GP. So Lauren, thank you so much for joining us today and sharing your experience with us. Before we get started with the conversational part, can you tell us a little bit about Lauren, your background, where you grew up, what you did before you started investing, and how you ended up here today?
Absolutely. Well, of course, first, thank you for having me on. It's a pleasure, and I appreciate you guys reaching out. And that's a very kind opening intro. Thank you for having me. So my background is this. I actually grew up outside the DC area in Arlington, although I haven't lived there in a long time, but I am sort of a native Virginia kid. After college, got married, and my husband is still active duty Army, so I'm a military spouse. So we kind of bounced around the country and then spent some time in Germany as well, and did a bunch of moving. And so kind of my real estate journey actually starts with that, because through the moving, I sort of knew like, hey, I really want to start picking up some real estate along the way. We have this great benefit with the VA benefit, so it was a little bit easier to buy. We would, get transferred somewhere, we'd buy something, and then we would lease it out. And the other kind of perk to it is that when you're leasing in the military, you sort of have this base of people that you can lease to that is going to transfer in and out. And so at the time, this is, kind of early 2000s, and the internet sort of is existing. I also sort of my day job was more web development and marketing. And so I knew you could do like a lot more stuff online than I think some people. They're very uncomfortable with the idea of sort of leaving a house and then moving somewhere else. And I was like, oh no, this could be self-managed. Like we can figure out how to do this. Even back then it was like people didn't even understand that you could like just have someone send a direct deposit. They were like, oh, but how are you going to get your money? I'm like, they're going to put it in the bank. So that was kind of the beginning of the journey. And over time we've, picked up, nothing crazy, but just, a handful of single family properties. Did, like I said, self-managed, even kind of did some, back when ebooks were a thing, kind of wrote a couple ebooks on how to do that and kind of helped some other military families start that journey. And so that was really fun. And then we went to Germany for 3 years and actually still continued to self-manage all those properties from there. So I was like, it's very doable. And then coming back from Germany, we knew we would probably be able to sort of stabilize a little bit more. Like I said, my husband's still active duty, but we're in North Carolina now, and we've been here for quite a while. And so I really wanted to get on the commercial side. And so and stop me if you have any questions here, but the gist of it is like, I had looked at self-storage because I have an uncle that has always owned a lot of real estate. And he had made the comment years ago, like, oh, self-storage seems like a great thing to go into. And I was like, okay. And I looked into it. And at the point at that point, it was still, you had to have like someone sitting on site and an employee. And a lot of times these people actually lived at the facility. This is not uncommon, especially in your tertiary markets. And I was like, I don't know. I don't know if I want to mess with that when I'm not even living in the country. And so I kind of put it in the back burner. But by the time we'd come back, a lot of the technology sort of caught up and you could do a lot of remote managing. Now, don't get me wrong. A lot of the Class A bigger facilities absolutely still have someone on site. And I think that makes sense for the product that they're offering. But for me, I was like, oh, this is great. I could buy something. It's unusual that every single tenant moves out. So the idea of like it going to zero, whereas at the time, industrial retail, I mean, I've come a long way in my journey, but at the time I was like, I don't know, like if there's no tenant, then what do you do? And so I kind of liked the self-storage thing. And it's more of an operating business than certain other types of asset classes, meaning like some of my marketing background and some of the things I brought with me, I felt like that could lend to that type of business well. And I could say, okay, cool. Like I do know how to, run all the ads and do the marketing side, and the tech side didn't scare me, and kind of like a lot of online rentals and things like that. So that is a very, very quick how I got from one to the other background.
Awesome. I love your journey, and thank you so much for your family's service. I know Paul is the one serving in the Army, but I think we would all agree that military service is an entire family affair. So thank you very much.
It does turn out to be that way. Yeah.
And just a real quick little disclaimer, because I know the questions that I want to ask. Lauren, Fernando, and I are not giving financial advice. We're just offering insights, experience, and perspective.
Yes, correct.
And you should always do your own research, consult with your tax and legal advisors, blah, blah, blah. You know the drill. So
yes, second that all 100%.
So how has being, you explained a little bit about how being a military wife kind of led you to where you are, but how has it helped you actually structure your company?
That's a good question. I think, I think something that happened in that lifestyle is you really had to plan like ahead a lot, and also plan to, a lot of things would change around you and the help wouldn't always be there. So I think it made me really think about like, how can I do this? Who do I fall back on if I need this extra help? And a lot of that stuff does transfer over to real estate, because you're sort of thinking about, really you should be thinking about worst case scenario quite a bit. So, something that I pull from my husband is like, assessing risk, what's real risk and what's just perceived risk, which is, I wrote in my newsletter, gosh, it's been months ago now, but like talking about, and this is just, I bring it up because it's an influence to me, but like he's jumped out of many, many, many airplanes over the years. People are like, oh, it's just so dangerous. Like it's, life insurance is hard to get because of these things. And he's like, it's actually like, it's actually so all the things we do to navigate the risk makes it really not very dangerous. Like once you realize all the steps that are taken to get to that point where you're actually stepping out the door of the airplane it's more dangerous to drive a car. You're more likely to be killed in a car accident than jumping out of that plane. But what that taught me a lot about is like how you do look at risk and how you have to sort of think worst case scenario, how do you backwards plan for that? And then knowing all that, then where is your decision? So I think that's definitely influenced me as a spouse. And then, just like logistically, it is a logistical feat to move frequently, to have like changes within your household of who's there, who's not there. So I don't know. I think that it definitely was a huge, it's a fabric of who I am without a doubt.
Right.
I think it's really interesting because Jennifer and I often speak about how you have to get comfortable being uncomfortable.
Yes.
And I really find it interesting that, there are people that will start investing in single family homes like you have,
mm-hmm.
and kind of stay the course. Well, I already know how to do this and I'm just going to stick to this. And then there are people like you that look at the horizon and see, well, there are other opportunities. And so, one of the things that it does prevent people from investing in areas outside of where they live, mm-hmm. is this idea of the complexities of being, an absentee owner, for a lack of a better term. And so, talk to me about that mindset, and and perhaps to the audience, what are the things that you have to look out for? What are the biggest obstacles when you are managing property and you are in another
country,
in another
totally.
continent?
So it's kind of interesting because I'll talk about it from two sides. Because when I was managing the single family homes, I really wasn't that bothered by being further away. I would kind of have, my list of people that I could reach out to, whether it was, everybody from just vendors that we needed if it was a repair. We actually, another military spouse and I created this program years and years ago called the Scout Network. And you could sign up as sort of like a gig economy of military, it was usually spouses, wives, not always, but oftentimes wives. And basically they were like the representative, like, hey, I'm a scout at this location, like Fort Bragg, North Carolina. And you could hire them just like you would a gig economy to go maybe check up on the painters or go walk through a property or whatever. So we kind of created this little side business off of it too, which was fun. So yeah, so I think you have to figure out how are you going to manage that from afar. And it's interesting because now part of my investment thesis is actually to be very, very hyper focused on my geographic area. But that is more because I think I don't think it has to be your geographic area. I just think you have to pick something. Like, it's not to say you could pick a totally different area. I had a conversation with a guy that was like living in Seattle and he was like, I can't afford anything here. And I'm like, well, then find a new up and coming area that you can drive to in 2 hours and make that your spot. But read the local newspaper, figure out, what they're voting on at the town planning meetings. Like that, I think is a shift that's a little bit different with commercial real estate because your risk assessment should be, there's more stuff that can impact you. Like if you're in single family homes, you probably can pick some neighborhoods that are pretty solid and make that decision with less information than when you're talking about commercial with zoning. Who's your tenants going to be? What's the industry there? I think that gets a little more complicated. What infrastructure is there? Do you have a water problem? Do you have a sewer problem? So I kind of sit on both sides of the coin because I think you can do it, but I think you just have to be really, really thoughtful about how you do it. And then you have people that are like totally geographically agnostic. They're like, I'm only going to buy storage, but I'll buy it anywhere. Then I think you just have to figure out how are you going to support that and keep up with what's happening in that area through your staff, through, however you want to build out your business like that. For me, I don't have the scale to do that. So it's not really a road I'd want to run down at a commercial side. Some people totally do it and do it successfully.
For sure. Yeah, I'm curious, how did you arrive at this new investment thesis?
Well, one, I don't want to travel. I didn't mention, but I do have 4 kids. My oldest is now in college, and then I've got 2 high schoolers and a middle schooler. So, but when I started this like almost 6 years ago, I wasn't even quite at that point, and my husband still was deploying a lot and things of that nature. So traveling was just like not an option for me. So it's like, I'm not ever going to put myself in a position where I've got a property that I need to go see and I can't get there. So then it very quickly was like, okay, so what radius am I willing to work in? Because to me, it's just very different to have an issue with maybe a commercial property that you've brought in other people's money in on and stuff like that, than like, hey, we own this single family home that we can solve that problem pretty easily from afar. I think those are just 2 different ball games. So I just really like the idea of being able to get in my car and drive to these places. And I also happen to live in a really economically strong location. So that just fit really well. Like North Carolina does really well. We have a lot of industry because of Fort Bragg on both sides of it. There's a whole bunch of other things that go into it. So I was like, why would I go look somewhere else when it's literally in my backyard? So for me, that just made sense. But like I said, someone else might have the circumstance. You're in a majorly expensive area, like maybe you pick a different place that becomes your backyard for this purpose.
For me, the lesson here is that you could be very intentional in your investment thesis in where you're investing geographically. It doesn't mean that you have to live there.
Right.
But it just means that there's power in understanding all of the dynamics that affect the local economy so hyper locally, and I love the idea of being able to look at a zoning map and be able to know, here are all the centers of employment. Here's how transportation affects here. Here's the, ingress and egress. Here's the totality of the products that I'm searching out. Is there enough quantity for it to make sense from an investment side? And then you really begin to see cities and neighborhoods in a different light. So there's also a sense of wonder and discovery when you're hyper locally searching and investing in an area.
I totally agree. I think I've always liked the term like the riches is in the niches, which, is a lot of times people talk about, whatever, building businesses and kind of doing something niche down. For me, I was just like, oh, this makes a lot of sense. I can really niche down in this area and just learn a lot about it. And, get to know the economic development office and the different town planners and, and I'm just like a very, very small fish in this pond, but it's easy. It's hard when you're small to try to like do all the things and try to be all the places. It's better to just pick something and really focus on it.
So tell us more about Serious Storage. How many facilities do you have? When did you buy your first one? Are you planning on growing more, et cetera?
Yes. So, so great question. So I bought our first one in 2021, sort of that post-COVID time. We had come back from Europe. I'd been doing a bunch of studying and reading, and I got really fortunate and kind of found something again, like kind of just in our backyard. And I was like, oh, okay, cool. This is good. This will kind of be my test run. So we bought that one, and it was like, I don't know, 150 units, something. I can't even remember exactly. These are all like pretty much like drive up, what I want to say crappy storage, but they're just drive up storage. They're nothing fancy. These are not like the big buildings you see in cities. And but it was exactly what I was looking for. No website, hadn't had rents rates in a long time, just really poorly taken care of, just a lot of deferred maintenance, and just not even deferred maintenance, just like lawn care. Like the guy that was watching the property was living in this other building close by and had his dog in there, and his dog was always like pooping in there and he wouldn't clean it up. And I'm like, who wants to, that's just not, so there was a lot of low hanging fruit to tackle with that one. So that was the first, implemented the business plan, absolutely had the advantage of some tailwinds in the economy with interest rates dropping, people going crazy over buying. And then from there I bought, so I held that for a little bit. And then I bought another one. And that was kind of interesting because it was actually a 3-parcel property. And we knew full well that 2 of the parcels were going to be snatched up by North Carolina DOT in a road expansion. But that was fine because I basically got a pretty good deal on it. And then I raised the value of it. North Carolina DOT paid us out on it. If you have a property taken over an eminent domain, instead of a 1031, you can do a 1033, which allows you 3 years to replace, to find a replacement property and allocate the funds. So that's kind of interesting. Have some parcel left for that. That's more of a covered land play, a piece of property that really should be something that's not storage anymore, just on the location. So we'll probably reposition that, redevelop it at some point. And then I've got these are all very close, another location, not far. And that's, again, a lot of with storage, drive up storage, you should always be like, is this potentially going to be repositioned to something else one day? So that's like another 200 units plus with some acreage there as well. Do a lot of truck parking there. Kind of same playbook. Low rates, not very well taken care of, all the things. And, just kind of went in, put a website in place, online payments, all those things. And then again, that's another one that one day they're expanding the road there. There's a whole highway that got added very close by, lots of growth. So it's probably best use is going to be something else down the road. And I had some investors in on that one. And that's kind of the playbook that I had said, like, hey, this is a sort of a long-term hold that we, hopefully reposition at some point in time. That's kind of the goal. In the meantime, I did decide to sell the first place, which I'm mostly a buy and hold buyer. However, there was so much equity locked up in that. And I was like, I need to be able to get more money so I can go buy more things. And I kind of wasn't sure that those prices were going to hold for the long haul because, you start to think about how long are these interest rates going to be that low, and can I get a better amount now? So I sold that first one and just reallocated. And I've got another property, but mine are all fairly small with land. A lot of times I do property and then land, try to get land around it. So I've got another one that's a smaller one with some land. And then we actually added another building next to it. It's a small industrial building with another whole bunch of acreage next to that. And then I had some climate controlled storage that we got last year. It's just been kind of slowly adding. I think the trick with storage is like, if you own one facility, your operating costs are going to be pretty high as a percentage. Your ratio is pretty high because it really is an economy of scale. Like if I could add hundreds of more units and my cost right now is not going to go up much at all because I already have the customer service team in place. The property manager is like, sure, like maybe you're paying a few more hours to have someone go out and check the property weekly, but you can scale quite a bit before you're really hitting like, okay, now we really need another person. And frankly, with some of the AI stuff that's coming out, it is lessening the amount of like people contact we have to have. We still do like to have people answer the phones, but there's some gateways we can put through where they're not needed until maybe step 2 instead of step 1. So that's hopefully answers your question. But yeah, I think I think that's the one thing about storage that people realize it is actually very much an operating business. You really do have to market it. You really probably still need a customer service team of some type. People still really like to pick up the phone and rent over the phone. We do some online rentals, but surprisingly, a ton of people still like to call. They have questions. And so I think it's one that you try to add more units as you can.
Tell us a little bit about that first deal. Did you buy that by yourself or did you GP it? If you bought it, was it a VA loan? Was it an SBA loan?
Yeah. So that one, we bought it by ourselves. So basically I knew for sure that with a small amount of family money, which was obviously very helpful, but I knew for sure that I was like, we don't want to do any outside capital that's not like immediate, pretty much. So we did that. And when I went to go this was like such an eye-opening experience for me, because at first I was like, oh, I could do an SBA. And then SBA has a ton of hurdles. And one of the hurdles is that they want 3 years of tax returns from the seller. And the seller, who I like very much and is still a friend of mine, but he was like, absolutely not. I will not hand these over to the SBA. They don't need to know all that information. And I mean, I'm kind of like, yeah, I get it. Like, I don't, they really only need to know about this property, but they wanted the full tax return. So he just refused to do it. So I was like, oh man, that's not good. So then I was like, oh, I got to get a commercial loan. It is not to be discouraging, but just to be like eyes wide open. It is not the easiest to be brand new on the commercial side and get a commercial loan. So you probably should be prepared to start small, which I did. So actually the guy that was the seller, he said, hey, I know a new business bank that's opened up in North Carolina, and they still are here. And he's like, and I happen to be an investor in the bank. And so I really want you to contact them and see if they'll do the loan for you. And so I think it was like $750 we paid for that, something right around there, maybe $720. And so they said, well, we'll do up to $500,000. And I said, whew, okay, cool. I have some money, I have, some, but we still need more. And so I went back to the seller, and somebody had said, like, he'll never do a seller finance. You'll never get him to do it, whatever. And I said, well, the worst somebody can say is no. So I did go back to him. We had a meeting, and I said, this is where I am. This is what I'm bringing to the table. And I don't even remember how much it was exactly, some amount of equity. It wasn't a ton. And I was like, can you make up the gap for me? This is what we're looking for. And he said yes. And he said, yes, he would do it. And so he did the seller's note. He took a second to the bank, which I think because he was an investor in the bank, that was the only reason he was willing to take the second to the bank. Again, there's some tailwinds there that I got to take advantage of. Like, I do think we improved the operating a lot of that property. But it also helped that some of the economy, the way that it went during that time frame. And I was able to refinance out and give him his portion back pretty quickly within the first year. And then after that, I had a conversation with someone that because I was always like, I never sell. And they were like, I don't know, you got a lot of equity in there. And you need to go run your numbers and see if you could take that and put it in some different properties, if that might help get the ball rolling and, snowball effect. And I was like, okay, I think they're right. I need to pull this out so I can actually buy some more things. So that's kind of how I financed it.
I think that's a great story, the equity part, because that happened to me with an investment where it was a single family house, again, bought it during COVID, but at a great price. And I had built up, because of the run on real estate with COVID, I made my 5-year buyout in 1 year. And then it became like, I have so much equity, do I hold it and it's going to keep going, but nowhere near at the rate that it's doing now, or do I take that out and invest in something else? And I think the fact that you had that same thing with the your first self-storage, especially your first one, right? Because that's like your baby.
Well, right. Yeah. And you've made, like, we didn't come in with tons of money. So we were like, okay, right, man, there's a lot of money in here that we could really put somewhere else. So did you end up selling that house?
I did, yeah. Because the other thing was that I knew that in Florida, the taxes resets after the year.
Right.
So I knew my property taxes were going to go up. I knew my insurance was going to go up. I knew I was going to have to spend a lot of money improving the property. And I'm like, why would I do all that if I've made my 5-year return in 1 year without spending any money on it. So, but it is hard because then you think, oh yes, but I got it at such a low basis. You know, that
it is hard because I do love the hold forever. I've kind of shifted. I think there's sort of a balance in there. Maybe like generally for every 3 properties you buy, you keep 2 and you sell 1 sometimes to try and keep. Like there's some properties that really like you could go in, do a value add, and you've pretty much all the money you're going to make, you've done right there, and you're not going to make a ton more. So really you have to kind of know what you have and what you're going to, what the business plan looks like, and then what you think the future might look like. But yeah, I always encourage people like sit down and, I mean, now you can have AI run all the numbers for you, but just like say, if you've got $300,000 of equity now that you're going to be able to pull to the table, and you could put that across 3 different properties maybe, and or however you want to do it, like you just run those numbers and see what that looks like, because you could be doing yourself a favor to get that money out.
Right. Did you consider doing a cash out refi and still decide to sell?
I did. I actually did do a cash out refi and then decided to sell, which, you know, like ultimately I was like, oh, I should have paid a bunch of fees I shouldn't have. So there's some lesson there. But the thing about the cash out refi is, I will not, and I actually am even more like this now than I was even then, which is like, I just really want to keep a small loan to value. So when you go do a cash out refi, I'm still keeping a lot of equity locked up because I'm unwilling to have much debt on it. I mean, if it's just my husband and I will do a little bit more just because that's our risk to take. But I mean, even still, I don't really believe in it because I think it's just how quickly you go upside down. So that's where I think the cash out refi, you sort of limit yourself sometimes, even though I love them. I just did one and it's great, but you know, it depends.
There's so many lessons in this episode, you know, because I do understand the you know, the instinct of buy and hold forever. And I think the caveat there is, you know, when you have the opportunity to scale, right, the economies of scale are always going to be in your favor. And so it makes a lot of sense. And you're a walking, talking case study on how to do this properly. And I just want to reiterate for anybody who's listening, look at the lessons when you're looking at, or as Lauren told the story is, you know, first of all, utilize your strength, what you know. And it's your marketing background, your experience in business, and understanding how you can add value to a running business, understanding the asset for what it is. It's not only real estate, it is a running business. And so now I have the opportunity to add value. And then lastly, I have with the understanding that there is a future development potential to owning this. And so it's not its highest and best use today. I could improve upon it. And if I come in at the right basis, then it just makes sense. And then another lesson, which I think it's very smart, is to the point of economies of scale. You understand I could add more units and not necessarily increase my expense. And the more units that I add, the better the business really runs, especially when you have, you know, difference around town and you could have one manager that is kind of looking at, you know, all the different ones. So no, it's fantastic. I'm wondering, as you know, jumped into this and now you're running this business side, was there anything that surprised you? It feels to me like you're very well prepared. You do a lot of planning, but you know, ultimately there are always surprises in the execution, right?
Yeah, I mean, absolutely. I think that's you have to you have to try and prepare for those surprises as much as you can. I do a lot of research. I do think that I don't know if I'd use this as a surprise, but just like I feel kind of fortunate that when I really transferred over to the commercial side, which is about 6 years ago, I've really been able to already experience a lot of I wouldn't say a full cycle of real estate, but a lot of it, you know, like sort of a boom, which obviously had been happening for a long time. And then sort of to see, and I wouldn't call this like a total bust, but there's obviously been, you know, when your interest rates go up very quickly, that impacted a lot of people. The impact has been from observation and not as much on my personal side. Although I think just, you know, even in storage, you can feel the economy is softer. It's a little bit harder to get rentals. We've really had to improve our sales process. So there's some lessons there that are, you know, what I sometimes would think like, oh, this is a super conservative growth rate. I'm like, oh, that's probably not, it's fine, but it's not quite as conservative as I thought it was. Cause now that I'm experiencing sort of a downturn, you know, it really does make an impact. Yeah, I don't know if that totally answers your question, but I mean, I think I've been
Lauren,
really fortunate.
Speak to that, because maybe a lot of people listening don't understand what affects the health, if you will, right, or the cycle of of self storage. When you're seeing those upticks and downticks
Yeah.
in in activity.
I think it's self-storage, like a lot of things, is very hyper local, right? So kind of reminds me a little bit of single family homes. Like you could have, I mean, geez, a house could sell 2 streets over far better than one, it's slightly different because maybe they're in a different school zone, like all those things that kind of go into play. Storage is a little bit like that because it depends on what your clientele is around. So if they're a clientele that's going to be more impacted by the economy, you're going to see that, that you can see that, feel that hit with them. They're just, you've got to run more deals, or you have more issues with people paying on time and stuff like that. Whereas if you're in an area where the economy is a little bit better, or maybe there's more stability with jobs or those different things, then you don't have those problems as much. So I think you do. It's hard to put your finger on it, but when you're, and the other thing about storage, and I'll say this too, is like, it's what you're doing, but it's also what your competitors are doing. So unlike maybe an industrial or retail or stuff, like obviously your competitors are there, but it's sometimes harder to know. Like I have some industrial buildings and it's like, what is the rent rate? Well, if you ask all these buildings, like what their rent rate is, like you can get a real variety of numbers. Storage it's published, it's online, people can go shop it. It's kind of like apartments, right? So multifamily sees the same thing. And so then you have this like, oh, if our main competitor is doing this and they're going to the race to the bottom, like if you don't match that to some degree, like it's just a numbers game. It's a commodity. It doesn't have anything really special about it for the most part. So that's where you start to feel the softness where you're like, oh, okay, well, they're running a deal. So now we got to run the deal because otherwise they're just going to beat us out because that customer doesn't really care. They don't care about my brand. They don't have any allegiance to that. So that's, I think, a little more challenging in storage. Every asset class has its challenge, but I would say that it's one of the ones with storage.
Just one last question, just because, this is a topic that a lot of our audience, we haven't had a robust discussion on self-storage. If you were to develop, a new self-storage, drive up,
yeah.
What are you looking for in the market that you feel is going to strengthen the demand for that product?
Well, so there's some numbers out there that people use for like how many square feet of storage exists per household or whatever. Somewhere people like if you get below like 8 to 11 is kind of a range. I mean, do people have basements or do they have, if they have basements, they probably don't need storage maybe as much. Are there a lot of multifamily homes there? So it's like apartments where people need more storage. I have a place that, like one of my places, we do a lot of camper and RV storage, and it's much more common because there are a lot of gated communities and they don't want those things at their houses. But I have another place that's much more rural, and most of those people don't need that because they basically park like on their land. So I think you have to really look at like what, how many houses are there? How many rooftops? How much storage is there? The saturation is there, and then what other sort of factors could go into people using the storage? Are there businesses? Like in our climate controlled, we definitely have a lot more businesses that use storage, whereas in our non-climate controlled, we don't have as many businesses that use it. Some, but it's not quite as many because in your climate controlled, you're going to have even like lawyers will use it to put papers in there or like things they have to keep on file for some number of years, stuff like that. So I think it's just kind of knowing what you think your clientele is going to be. And then I always just like with storage, like back it out and see what else could this be if it gets oversaturated. Like in climate controlled, for example, we have some buildings where they actually didn't start as storage. And then the old owner, they were so overrun with people wanting storage. They ended up putting more walls interior. You could technically pull those out and it could just be open industrial space again. So it's kind of interesting too, to think about it from that perspective. That's a little different than drive up. I mean, drive up is pretty much drive up. So I don't know if that answers your question.
It does. No.
So your first one was friends and family and your husband and seller financing. When did you start doing GP? When did you? Very slowly.
It really it took me a long time to make the decision to do that. I probably I think it was a good decision for sure. There probably was more capital like in the 2021, 2022 that I could have grabbed and like bought more stuff, whatever. But I've also seen some people kind of go underwater with that situation. So I'm happy that I just did it the way I did it. So yeah, I started first one was just really us with just like a little bit of family. Second, like a little bit of family. Then I just slowly brought in just a couple friends, and then like two just outside LPs that I had met by that point in time at, I think, a conference or something like that. And then I've just kind of slowly been building, I don't have a lot of deals with a lot of outside capital. I just have a few, and I would definitely do more. It's pros and cons, right? Like somebody said the other day, asked me and a couple other GPs, like, oh, if you had the choice to take no money or just fund it yourself, what would you do? And everybody's like, just fund it yourself.
Fund it yourself,
right?
100%.
Like it's just, it's definitely more work. But on the flip side, I do actually really enjoy giving people the opportunity to invest in a different type of way. Like most people that I know are most of their investments in the stock market. And while they can do really well there for sure, they have no interest in buying commercial. They don't want to run commercial. So they are happy to kind of get this diversification. So yeah, and then last summer I bought sort of my biggest deal, which for me, I mean, big for me, small for a lot of people, and I brought in a lot more LPs for that. So that was a 503c. So that's like where you can actually talk publicly about it and promote it more. And so I brought in a larger number for that buy. And I, going forward, would I like to buy more on my own? Yes, but there is a range where you have to decide, like, it's all about, if you put it on a timeline, it's extremely hard to scale unless you have a lot of net worth or independent, like whatever. If there's more money and capital from somewhere else, great. But it is extremely hard to scale if you stay on your own. You can do it. It's just going to take a lot more time. And if you want to scale and you want to move a little bit faster, then you probably are going to have to take some outside capital.
So tell me a little bit about, because your last newsletter is what intrigued me so much now that you've done a couple of GP roles. And in your newsletter, you were having a discussion about how a deal should be structured in order to keep the GP motivated and involved.
Yes.
And I think that is a brilliant question, because I've seen some deals, and I'm mostly LP. I don't GP, right? I either buy on my own or I'm an LP. And I look at what some of the GPs go through, and I'm like, are they making enough money? Like, are they going to be able to, if we lose a ton of tenants, how motivated are they going to be with this deal to go out there and rent out when they're not getting leasing fees, right? Or something like that. So tell me a little bit about your thought process on that.
Yeah, and this is something that's definitely evolved over time. When I first did I first brought in some LPs, we did a straight split. And I mean, to be honest, partially that was just because a couple of my friends and family are just not super savvy into real estate. And they were like, what's a pref? What's this waterfall? Like, it just was very confusing for them. But I was like, let's just do a straight split. I mean, like, it just is very easy to understand. I like simple things. I like simple math. And so that kind of worked well. And then in my last one, I did a pref, and that's totally fine. And I think sometimes when you are bringing in a lot of LPs and, this is a deal I really wanted to get done, and I was like, okay, I might just have to, do something. It's not like I'm on the losing end or anything. It's going to be totally fine. But, I was like, a lot of these LPs really want the pref because it became very popular. And it became popular because during the boom, it was fairly easy. I guess I don't like to use the word easy, but it was relatively easy to meet the pref, to do a quick refinance, cash out, get everybody there for the return on capital. So then the GP could get into the promote. Like, that stuff was happening. Well, then now what we're seeing is quite a few people that are like, man, I have no idea when I'll get into my promote. It could be a long, long time. Like this, with the economy, it's, another boom is probably not in the future anytime soon. It's probably going to be a slow growth like it has been. And when you start to look at those numbers, you realize like, oh, I mean, I'm behind this for a really long time. And as a GP, now don't get me wrong, there's a lot of bad actors out there that have a ton of fees, and they put so many fees up front that they like are getting paid. But if your fees are pretty reasonable, I think sometimes people would be surprised how little the GP is making for the amount of time that they put into the deal. And so that's kind of why I've been like, hey, I think going forward, I'm probably going to do just a straight split again, or maybe if for some reason there's really a pressure to get the pref in there, like a way to crystallize the promote that's not actually selling. Because that's my other problem, is that I'm a long-term holder. And so that also doesn't align very well with long-term. So if if your plan is to sell in 3 to 5 years, which, by the way, if that's your plan, you should really make sure that your backup plan of being a long-term holder still makes sense, because that doesn't always work. Then it's really hard for me to say, well, how am I ever going to get into that promote? It's going to take a long time because, we don't have this plan to sell. And if you don't sell, and I also, as I mentioned earlier, I don't do high loan to value. So in a recent cash out finance that I just did, my max was 65%. So like I did return capital to investors, but I won't return all their capital for a long time because I'm unwilling to take on the amount of debt that would require me to return all the capital. So I will sit behind that. Now, we did a straight split on that on the operating side. So that's kind of how I dealt with that one. I said, well, why don't we do a straight split on the operating side? I don't have to wait for return of capital there, but I will have to wait for return of capital to get into the split on on any refinance or sale. It's kind of the way I broke that down. So it felt like it was incentivizing actually operating the property, but still giving the LPs the priority of saying, like, I do want to return your capital to you. Does that answer your question?
It does. Thank you. And can you just briefly go through a real quick list of what the GP does? Because I think people just think, oh, you go out there, you find the deal, you raise the money, and then you sit back and collect the funds and,
It might be a quick list, but it's going to be a long list.
Yeah,
okay?
yeah. So I like to say, I actually wrote a newsletter about this a few months ago as well, too, like sort of a day in the life of a small GP. I mean, and it's different, right? Like I'm small, I don't have a big staff around me. I do a lot of this stuff on my own. I have some people that help operate, but they're not really doing the GP side. So you got to find it, you got to fund it, and then you got to run it. And so that's like the three things that make real estate go. Finding it, I mostly buy off market. Like, not that I'm opposed to buying on market, but I've just been pretty fortunate to find some good deals by doing some off market digging and some relationships. And so that, and and then when I say fund it, so find it also includes like doing all the due diligence that goes in, which is a long, long list of things to do due diligence. So that's sort of in my find category, because you haven't really found it if you haven't verified that you can actually buy it. And then you also got to fund it. So whether that's going to be bringing in equity with investors, so there's a lot of investor conversation, and then you have debt side, whether that's through some private debt or going to a bank or seller financing. I've done quite a bit of seller financing over the years, which is definitely easier than the bank for sure. But even with that, like if you're doing seller financing, you best be ready for that bank to take over, because at some point you're probably got a balloon on it and you want to get out of it. So I just did that. I had a seller finance deal that we just put bank debt on. And so, I had done the phase one. I had done all the things that I knew the bank was going to want to ensure that we could definitely put bank debt on it later. That's the funding side of it, which is fairly time consuming as well. And then you're like, oh, we closed. Congratulations. Well, now you have to run it. And as a value add buyer, which is generally what I do, there's almost always either a good amount of CapEx that we do on a property, or we're kind of putting with the storage. CapEx is sometimes more like the industrial side, but with the storage, I mean, it's transferring over all the tenants, putting our software into place, getting the customer service team up and running with them. It's almost always, we have a ton of abandoned units, people that aren't paying, like all this cleanup to do, and then additionally, usually like maintenance and repairs actually on site. And then you kind of come back to your people that have invested with you or the bank, and you also have to keep up with all your reporting. So then you have to send out reports. If I'm still transitioning a property, I send out a report monthly. If it's sort of stable, I go to like a quarterly report. All that stuff has to be done. The banks sometimes want reports. So there's actually quite a bit that just comes into like running the whole business. And that's kind of the wave tops. And I mean, you put out a lot of fires too. I mean, it's, on the operating side, that's the stuff that you should be having more people do for you. I'm kind of, try to insulate myself from every little thing. But there's always going to be little issues and small things to deal with. And then, and then you've got property taxes that go up, and then you're maybe going to try to fight those off. And then, I mean, there's just a lot of stuff, but I think it's those three categories that really are the place that you spend a lot of time.
Thank you for that. I appreciate it.
So two things. First of all, this Women in Real Estate conference keeps paying incredible dividends. All right. I love that conference, even though I'm not able to attend, but I gotta say it's very powerful. Secondly, you're holding out on me again. What's with this newsletter, and why am I not a subscriber on this newsletter? What's going on? I want the newsletter.
Before we get to the newsletter, I'm going to get you to the newsletter, but I've got to ask you, because we talk about why. Like, that is a question we ask any agent that's joining the firm. We ask it of our sellers. We ask it of our buyers. They all kind of look at me funny. But I love the story about your company name of Everett and Harvey. So can you tell us a little bit about that, since that is your why? And I just have to tell you, your why comes through the whole time you're talking.
Oh, well, thank you. I appreciate that. So yeah, I mean, my big why is really my family. I think being able to hopefully have something that we can pass down to them as they go out into the world and, help them grow their own families or their own careers, all that stuff. It's really important to me. I would love to see one of my kids come in on the business potentially. So I'll answer your question in two ways. One, back to the newsletter. That's basically how I write my newsletter. Is I pretty much write it like one day one of my kids might want to kind of understand the journey better. And it's much easier for me to write it that way because I'm sort of just writing to them and inviting an audience to follow along. And with that, when I was kind of thinking of the name, I just, there's a lot of different such and such capital, such and such capital. And that just didn't really resonate with me. And, it just had like a lot of sort of like finance bro vibe to me. And I'm not a finance and I'm not a bro. So Everett and Harvey is my dad's middle name is Everett and my husband's father's middle name was Harvey. And I just really loved the idea that we're sort of this family unit and we're sort of doing this for our family and to try and, give to the next generation and then continue. I mean, they did a lot for us, like coming in, right? So, I mean, they provided for us, they provided education, they provided these support, all these things that our parents, so my husband's father passed away years ago, but, he did all that for him when he was growing up. And so we just kind of liked the idea of bringing in that, that lineage and kind of carrying it along. So I hope my kids are still fairly, like I said, I've got one in college, two in high school. They're fairly young. They're not like really into this idea yet. And maybe they never will be. But I hope that one day they'll at least appreciate like sort of the story behind it.
I love that. I love the story. I also love the name Everett because my grandson's named Everett.
Okay, yeah, it's actually a great name. I know my son's name is William, but Everett would have been probably next. So it's a great name.
And then to Fernando's point in closing, if you would like to sign up for Lauren's newsletter, you can go to the website, which is www.everettandharvey.com, and we are going to put a link to it in the show notes. You can also sign up as a potential investor for her next deal. Even though you've heard her here, vet her, do your due diligence, do your own due diligence, because you know that she's a long-term holder. So it depends what your goals are as an investor as well. But I just want to say that at the Women's Investment Summit, we always talk about how we bet on the jockey, not so much the asset class or the deal. That has to be aligned with our investment goals. But whether or not we as individuals decide to invest, it's all based on the jockey. And if you listened to our interview with Bob Gillespie of NAR, Second Century Venture, he was talking about how he bets on the founder of a company. So I've got to tell you that Lauren, both as a jockey and as a founder, is amazing. I think you got a glimpse, just a small glimpse of the amount of knowledge she has, her willingness to share. So anyway, we'll include the website link so you can get more information from her. Your newsletters are amazing. I love them because it is like you're talking not only to your kids, but to me as a person, bringing up insights that I don't even think of asking, but they're questions that probably should be asked. So thank you for that. I also think you should include your newsletter, since you're already doing the work, as a blog.
I really should get him on. I actually need to redo my whole website, and I probably should get him on there because it might bring some traffic.
You've done so much work for him.
That's true. I do enjoy. I will say it's like almost every month I'll be like, oh man, it's kind of a chore to write this thing. But then once I get it out, it's really nice. It's a great way to connect with people, and frankly, it tells people how I think. And I mean, listen, I agree with you. Bet on the jockey, and just know. I mean, the jockey may not always be right. There are deals that are not going to go always the way they're supposed to for a lot of outside things. But was the intent of the person that was running the deal to, at the very best, like make sure they did everything they possibly could to make sure this deal was good? Or was there some kind of like nefarious behavior, or kind of like, oh, we've just seen some stuff sort of come through in the last few weeks of, some of these commercial real estate deals that are starting to go belly up, and you're like, yeah. And if you really kind of looked at the behavior of some of the GPs, there should have been some like red flags there. And I think that's the thing. It's when I'm seeing people respond to is, yes, of course they're going to be mad if they lose money. Absolutely. But like, they're also really responding to the behavior that went with it, not just the loss. And so I think that's really the trick, is when you're vetting people, is like, just figure out who you're kind of partnering with. Because it's not always going to be perfect.
Agreed. And I mean, real estate doesn't always go up. Deals don't always work out. You can't you can plan as best you can for the worst case scenario, but oftentimes you can't even imagine what the worst case scenario is until it happens. Like,
yeah, crazy
COVID.
Things do happen. I mean, right now, some people really suffered initially in COVID, and then it kind of bounced back. And like, nobody could have seen how that was going to impact. So yeah, so I think it's kind of just like, are you going to be comfortable with this person and the decisions they're going to make, when something doesn't go as well as it maybe should have, or some crazy event happens. So
I'll tell you a brief related story, Lauren. I have a client of mine who's become a very close friend. We've worked together for over 10 years, done, over 20 deals together. And he's a GP. And early on, I think maybe it was our fourth deal, we ran into an issue that was quite significant, and attorneys had to get involved, and he had just finished speaking to his attorney, and then we got into a call to, I was getting an update, and he was telling me a story of when he was in college. He took a sailing class, and one of the last final exams of the sailing class is you had to go out, the whole group, and everybody has a job to do. They go out and they hit some terrible weather, and everybody is scared, right, concerned. And he goes, like, at that moment, there's so many things that are happening. But once I looked at the captain, the skipper, there was no fear. He knew exactly what to do. He was guiding. He was calm, and I think that that's what people want out of a good GP, is that when things are not perfect and the conditions shift, are they going to be calm? Are they going to be able to guide me? Are they going to be data driven? Are they going to give me information? Is there going to be a plan?
Right.
And I think that's an impactful way of choosing your GP.
100%. And transparency on what that is. Because that's the other thing too, is like, I think what people get really frustrated with sometimes with the GP is not that something went wrong. It's just that they just didn't really share what was happening. I kind of like to do, when I write my newsletters for a specific, it's not my general newsletter, but when I put up like a report kind of, a blurb, I try to kind of include like, this is what's going well and this is what's not going as well. Because it's just not going to always be perfect. And I mean, unless you're like 100% occupied at the very highest rate that you possibly could be, like, there's always going to be things that you could do better that are not going as well. So I think it's important for LPs to kind of get the full picture, to your point, because then I think you when it gets rocky, you're like, okay, well, that person is at least like leading the way, and the best that they possibly can with the knowledge they have. So it's not easy for sure. Be nice to your GPs sometimes, especially if they're
yes.
they're good ones.
And be patient for the K1s.
Yes. Oh.
The K1s. That has to be the bane of your existence.
The K1s. I know you said that's another thing that people are talking about. What do GPs do? Well, they spend a huge chunk of their holiday season actually getting all the books ready to close out for the year so that they can, and I'm like just a small little operator. There's people that, even if you do, like, we do all our books every single month, reconcile everything, you still have to do all this stuff. I mean, starting in October, November, the CPA is back and forth a million times with all the questions to try to get those K1s out. So that's just like a GP thing you got to do. It's not like nobody's paying you an amount for getting all that stuff done. So yeah.
So in closing, I have to do a plug for the WIRE conference. And if you are a woman who is interested in investing or who already invests and you want to meet incredible founders and jockeys like Lauren, please be looking out for the WIRE conference. I think the registration's going to start sometime in September. I can't tell you the power of this community and this group. It has been the most impactful community I've had outside of my immediate friends and family in my life. And it is just such an amazing place to be. And you meet these women, and you may or may not get a deal done. You will see a lot of deals, but you're definitely going to walk away with great friendships and resources. So that's my plug.
Absolutely.
Thank you, Lauren, so much for joining us. I'm so glad you're here.
Thank you so much for having me. And I absolutely second your plug. The conference is amazing. I met Beth years ago, and she invited me to come and speak about self-storage, and I've been going ever since. And it really is like, I wasn't sure what to expect, but I mean, it really is this super fun group of women that are kind of interested in sort of the same topic and the learning and friendships. I mean, I literally have another one of my calls today as a group of women that are GPs that we chat about once a month, just to kind of compare and share and solve problems together. And that all came from that conference. And, Beth's leadership there too is amazing, Beth Azor. So if you're interested, I definitely come on. We'll look forward to seeing you in March or April, whenever it is this year.
I love it. I love it. Well, thank you, everybody, for pulling up a chair. Thank you, Lauren, for sharing your wisdom with us. It's been wonderful to have you here at Between Two Chairs. So for Jennifer and I,
Bye-bye.
Bye-bye.
Bye.